Hello everyone, this is Amol. Welcome to another edition of the Dark Arts. Markets are always sending a message, and it's our job as investors to decode that message. The message now, weekend of June the 6th, is one of optimism. Our economy is on the road to recovery, and every piece of evidence that I've examined suggests that we are in a bull market. So let's walk through all the evidence. Before we get started, I want you to know that this video is for educational purposes only. My information is below if you have questions. Look, markets are an iceberg, just like this one. Majority of the information is underneath the surface. Just looking at the S&P or the Dow does not give you the full picture. It requires a lot more work. So let's dive in and investigate. This is my favorite Yogi Berra quote. You can observe a lot just by watching. So what are we observing? We have a Fed that is all in. We have fiscal stimulus that is likely to last longer and keep growing in an election year. Consumers want to be out and are spending. We have reflation and rising interest rates. The rally is not just FANG stocks. Every asset class, stocks, bonds, commodities, and currencies are validating this rally. We have a rare signal called Breakaway Momentum, which suggests strong 12-month returns. Investors are still too pessimistic. Therefore, the evidence that I'm about to show you suggests that when the market corrects, which may be from a rise in COVID-19 cases, the right strategy is to buy the correction. All right, so let's get into the good stuff. So the Fed is aggressively pumping money in the economy, is growing the balance sheet. They're buying corporate bonds, which obviously is helping the market. This is the Q&A from the 60 Minutes interview with Chairman Powell. The link is below if you would like to look at the details. So when asked how long can the government borrow trillions, his answer was, this is not the time to prioritize that concern, which tells you the Fed will do whatever it takes and the support should last for a very long time. I think this is a very, very bullish factor as far as the markets are concerned. And this is obviously why the markets are responding to this. Stimulus is not just a US thing, it's global, right? Every country of any size has put forward a large stimulus package. Some of the details are here, and there's a link to the IMF blog. The last I checked, it was about 5% of global GDP, which is a staggering number and something that we've never seen before. And no wonder that it's translating into very strong consumer spending, right? So let's talk about some corporate results. Here are same-store sales from big box home improvement retailers. The results improved from March into April, and look how strong those May numbers are. Their same-store sales were up between 10 to 20% in the month of May. This is U.S. auto retail sales, a very long-term chart. As you can see, there's a huge plunge in the month of March when the average sales for auto dealer were down maybe between 50 to 60%. But then there's lots of reasons for optimism, right? This is a comment from an auto dealer that's based in the Southeast. We have continued to see increasing consumer activity in most of our markets. Our new and used sales volumes have performed at or above our expectations. The below paragraph, this is a large auto dealer based in the Northeast, but has businesses pretty much across the nation. They've seen significant improvement by the end of the last week of May, with same-store new vehicle sales decreasing 16% and used vehicle sales up more than 20%. Right, so that's a huge improvement from what we saw in the month of March. This is a comment from a casual dining restaurant. So casual dining sales were down, again, 60 to 70% in March and in April, right? What they're saying is by the end of May, early June, they'd captured 75% of prior year sales levels. So very, very optimistic. these are payment volumes. The top panel is showing you, if you look at the black line, right, where debit is strong because of government stimulus checks, but even credit has improved. And in the bottom panel, as you can see, the top line is e-commerce sales, which are very, very strong. But even the very bottom line, card present, is showing a nice rebound because businesses have reopened and consumers are spending. So I could go on with these corporate results, but the picture that's, I think, very clear is that corporate profitability going forward is going to be much better than what we expected, right? So what does this really mean for markets? So let's start with interest rates. So after being very weak and mostly declining since fall of 2018, interest rates are rebounding, not just in the US, but globally, in the UK, in Japan, and in Germany. This is the yield curve, and long-term rates are moving faster or rising faster than short-term rates, which is steepening the yield curve. And this is great for bank profitability. And when banks are profitable, that means that they can lend more. And when banks are lending more, that's very good for businesses, for borrowers, and for our economy. So guess what? After underperforming the market for more than 2 years, not only are banks rallying, they have started to outperform the market, right? And this slide has the last two things together, and you can see how important the yield curve is to banks. And bank outperformance is a very, very positive signal for the stock market. And this outperformance is not just a US-centric thing, it's also similar in European banks. So this is a chart of copper versus gold. Right? In good times, copper does better than gold, and in tough times, you get the opposite effect. You know, copper is an offensive metal, gold is defensive. So look what is happening, right? Copper is reversing a 2-year decline and moving higher. And this chart looks very much similar to the yield curve and the bank performance. So if global growth is improving, if rates are rising, if copper is outperforming, so it makes complete sense that material stocks are also following this trend, and it's exactly what we see. Same thing with industrials, right? And I think we see a trend here, right? It's the same trend of all the cyclical areas that were underperforming for a very long time are now participating in this market rally. This is discretionary stocks versus staple stocks. So in good times, we eat out and we shop till we drop, and in bad times, we fill the pantry and eat at home, right? So after that big drop in March, you can see that discretionary stocks are outperforming and doing much better than staple stocks, right? Another check mark for us in terms of the risk-on sentiment. This is the top panel is interest rates, and the bottom panel is gold. In the top panel, I have the US 10-year interest rate and the German 10-year interest rate. So as you can see, as interest rates started to fall, gold was rallying. And especially, it started to rally even harder as the German rates went below zero and the Japanese rates below zero. So investors were looking for an alternative to negative interest rates, and obviously gold was one of those things. But as you can see, as rates have bottomed and turned around, gold is selling off, right? Which I think is a positive thing. The next chart is S&P 500 versus gold, and looks very similar to everything that we've seen before, right? Market rallying and outperforming gold is a good thing. Now, this is one of my favorite charts, right? The top panel is the ratio of junk bonds to treasury bonds. Our junk bonds are riskier. Investors sell them during bad times and buy them, in anticipation of good times. And the bottom panel is high beta stocks, so they're sort of the stock equivalent of junk bonds. and the bottom is high beta versus the Russell 3000, which is the broad market. And they look exactly the same, right? So you have a rally post a European crisis, you have a decline during the 2015 correction, you have a rally in 2016, you have a very big decline in 2019, and year to date, and now a rebound. And hence the title, Risk Appetite in Bonds, confirming the risk appetite in stocks. Right? This is a comparison of different cap levels, micro caps versus mega caps. Right? Micro caps are riskier, get sold in corrections, and they get bought in anticipation of economic rebounds. Right? So you're seeing the same thing. Let's see how long this thing can last. The last one is the Japanese yen, which is a safe haven currency, right? Why it's a safe haven is a topic for another time, so just take my word from now, but it moves inversely to the stock market. And as you can see, at the very end, the yen rallied very hard in 2020, just as the market crashed, and is now going the other way as markets are rebounding. So now we've covered many company results in different asset classes, which brings us to an even more exciting topic. On Friday, June the 5th, we registered a signal called Breakaway Momentum. And you can go to these links if you want to go through more of the details. But what it's saying is that the first 6 to 7 weeks of the market rebound, it was really concentrated in large cap stocks, tech stocks, and some safety stocks. But over the last few weeks, the market rally has really broadened, and every subsector is participating in this rally. And when you get that type of participation, it's a very, very strong signal that this is a very sustainable rebound. It's not, or the likelihood that it's a bear market rally is decreasing. And the fact that these signals were firing during an incredibly tumultuous time for a country and for a community is, I think, even more telling. So here are the times that we have registered this breakaway momentum signal, right? And the median return over 1 year is very strong, and the total number of positives is also very, very high. So it's a very, very strong signal, and something that you shouldn't discount very, very easily without doing a lot of work. This is a slide from Sentiment Trader, and this is just another way of looking at the same thing. Here we are looking at 10-day up issues, where they go from less than 40% to more than 65% within 3 weeks. It's the same thing. You're looking at large participation of stocks, and it's only happened a small number of times, 7 times, 1, 2, 3, 4, 5, 6 times, and this is the 7th time. And over a 1 year period, the median return is 23.7%. And in this case, the signal has generated positive returns every time. So this is a slide from Ned Davis Research, which is a very good quantitative research firm. And here we're looking at forward results when 90% of stocks are above their respective 50-day moving average. And in this case, it's only, I believe, has happened 20 times, where the median forward 1 year return is about 16%. Again, very, very strong and compelling numbers. This chart is from Strategas Research, which also does incredible work. And here they are looking at the percentage of stocks at 65-day highs. And this rarely crosses the 40% threshold, and today we are at 46%. So this has only happened 17 times in the past 30 years and has very, very strong forward 12-month returns. So this is my own take on breakaway momentum. And I'm looking at when S&P stocks above 50-day moving average crosses 90%, and we're currently at 92 or 93%. It's only happened 4 times since post 2009, and Friday was the 5th time. So we can actually go look at each individual case, when it happened, what did the forward 12 months look like. So this happened in early May of 2009. The market had already rallied 33%, as you can see. When the signal was triggered, you saw a consolidation of the next 6 weeks, and then we had very strong returns going ahead for the next 12 months. The next time this happened was in October or early November of 2011. The market had already rallied 18% by that time. Again, you saw consolidation, a small pullback over 6 weeks, and then strong returns going forward. Another one came in early 2013. This time you had no pullbacks. You had a market that was just straight up. This is not part of it, but this one was closed. This is in this is, I believe, in March or late March or early April of 2016. So this is post the 2015 correction. You saw a 6-week consolidation, minor pullback, strong results ahead. And then the final one is in February of 2019. So that came after an 18% rally, right? You had consolidation, strong results ahead. Which brings us to 2020. So what do you do after this big run? I think you have to be patient. You have to wait for a pullback. There are always pullbacks, and then you use those opportunities over the next 8 weeks to reinvest whatever you need to or gain exposure to the market. And if you need help or if you have questions, you can always reach out to me. And this is, it's not surprising, but only 34 to 35% of investors are optimistic, right? So they're more bearish investors than bullish investors. And I think this is a contrary indicator. I think this, if anything, it adds fuel to the market rally. So what can crash the market party? And the obvious risk here is the number of cases. So as you can see, the total number of cases has always been rising. It's never really flattened out, and we've seen a little bit of a higher cluster in the last few weeks. So that's something that we need to be watching. So to sum it all up, what are we observing, right? Very, very strong Fed and monetary policy stimulus, which is backstopping the market. Consumers are spending, interest rates are rising. We're seeing a reflationary environment. We have validation from stocks, bonds, commodities, and currencies. The market breadth is very broad. Every sector, every subsector is participating in this market, which is leading to breakaway momentum. And in general, I think investors are still too negative. So the evidence today is that this is a new bull market, and you need to be buying pullbacks. So this is my story, and I'm sticking to it. I hope you enjoyed it. If you did, please let me know. If you think this is voodoo, you can shoot me an email either way. And if you have any questions, more importantly, you can reach out, Desai at latticeworkinvestments.com. That's it from me. Good luck investing.